Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, sitting here once again with the co-host John Teixeira. And this week we have brought in Trevor Kerr with Gateway Mortgage once again to discuss the mortgage market. If you guys have any questions about anything we talked about today or anything you want to discuss on this beautiful February day, give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. Let's get into it. Trevor, thanks for coming in today. We appreciate it.
Not a problem. I appreciate you guys inviting me in and glad to be here today with you guys.
You must have done some good things the last few times we had you in, or we wouldn't have brought you back. So, I think we'll continue this. So, mortgages in 2025, have they changed at all?
No, there hasn't been any changes right now. And listening to one of the top economic forecasters just the other week, forecasting 2025, and let me preface it, it's Dr. Dotson. He's one of the more respected economic forecasters out there. But like he told us, he goes, best economic forecaster is about 50-50 coin flip. So half the stuff I tell you might be right and half of it might be wrong. So we'll see. But kind of, a general synopsis of that meeting and stuff is he kind of predicts 2025 to be pretty similar to 2024 as far as, inflation and interest rates and housing and stuff is going to be pretty similar to what we saw in 2024. So sad to say, I don't think that we're going to see a huge reduction in rates. Right now we just got under 7%, for the first time in about a month or so. And so He's thinking they're going to settle down right around 6.5%, which is a normal, healthy market, out there. So
yeah, we've talked about that before, Trevor. By the way, thanks for coming in again for our first update of 2025. I think it's really important to remind ourselves, especially for this podcast is geared toward investors, right? And so it's really important to remind ourselves where we've been, the history of where we've been and where we are. And that's really why we wanted to have you here again today, was because even though things aren't changing, so to speak, all the times that we've brought you here, there's been a little tweak or a little bit different spin on what the market is, like what you're telling your investor clients to do right now. And so like in the past, we've talked about, adjustable rate mortgages for a small period of time. We're working really well for investors, and then they became not such a great product. So what are you telling your investor clients right now?
Investor clients right now that are still the number one way to build wealth, in the safest way is owning real estate. Okay, that has never changed, and it's still is the same.
That's why
today,
we're here.
So. Yep. Building your long-term wealth and stuff is owning real estate. So if instead of trying to time this market and hope for the best and wait for rates to come back down to 5-something%, it doesn't make sense. By the time, if rates do come down to 5-something% in a couple years, look how much equity you have missed out on with the, prices going up. So,
and not to mention buying opportunities. Yeah. Kyle and I have talked a lot about in past podcasts about the buying opportunities that are out there right now are really good. I mean, I saw a half duplex yesterday that gosh, if I was ready to snatch something up, I went and bought that yesterday, right? I mean, the pricing I'm seeing right now is just incredible. And so get over what the rate is, right? Yeah, which is actually still below your historical average. I mean, I always tell people historical average is 7.75. Is that still true? Has that changed?
It is. No, that is.
So if we're in the sixes, if we're even at 7 and possibly going down to the sixes, you're below our historical average. You're like you said, that's a healthy place to be. It's a healthy interest rate, and if you can live there and invest there, then that's a good place to be. Now.
And like a lot of people say, date the rate, meaning if rates
marry the house,
down,
date the rate.
Yeah, you can always refinance down the road.
Yep.
So don't miss out on an opportunity today because you're hoping that rate's going to come down 0.5%. Grand scheme of things, it's not a big deal.
So it's okay if you kick her to the curb and you go get you a new, younger one that's smaller?
It is in this situation.
Oh, okay. All
now,
right.
if your
All
wife's
right.
listening,
Okay.
she might not like that
I don't think
analogy.
she listens. Yeah.
She doesn't want to date the rate either, though. So, but I mean, we know how this goes. The economics of it are what people need to focus on. Is if the rates do go down, prices will go up. At least in our immediate market, is we still have pent up demand of everybody waiting for rates to go down, and these huge supply shortages. So you know, rates go down, prices go back to right back to where they were.
Yep.
Something catastrophic happens, and we get the Fed to drop rates to zero again, which is not what anyone's cheering for. But what would happen? Home prices
are going to go through the roof. You know, but again, that is the only way rates are going to come down significantly if something catastrophic happens.
Yeah.
So, you know, knock on wood, nothing like that's going to happen. So I foresee interest rates staying pretty level.
I do too.
This whole year.
Because honestly, with how close we are to the last catastrophic event, it would have to almost be worse than that.
Oh,
It would for them to do that again. And that's been kind of the tug and pull that we've seen, is that there were projections to have lower rates this year, you know, prior to the election.
Sure.
Now the market's pricing in this whole tug of war with tariffs, with the interest rates. I think that'll be interesting to see play out. You think it'll have a big effect on?
I don't think it's going to have a huge effect on mortgage rates.
Yeah.
But
building costs, it'll have effect on building costs.
It is going to have an effect on building costs. It's going to have an effect on everything.
Renovations. You know? Yeah.
Well, no, it doesn't have an effect if they don't exist. You know, they didn't actually get implemented. So, you know, but trade wars affect markets.
Are we getting a new Fed chairman?
You can only hope. You can cross your fingers. You know.
I mean, if we did, does that you think that affects anything, Trevor? If we got somebody, if Trump placed somebody else in there,
Jerome Powell money machine might slow down a little bit.
He's going to try to implement some new policies and stuff, but a lot of people don't understand. They can't just click a button and say, okay, here's what rates are. The only way to do that is to artificially pump a lot of our taxpayer dollars into the bond market.
Yep,
so
mortgage secured, yep.
Which they're not going to do.
No.
I think we've learned our lesson on that, I hope. So,
well, the Federal Reserve's currently holding like a ton of the bonds. So
Trump did just get rid of the director of the CFPB. So, you know, he's trying to shake a lot of stuff up.
He technically can't remove the Fed chairman. So he can appoint them, but he can't remove them. So it's up to him. From the sound of it, it doesn't sound like the Fed chairman is going to be listening much to the president anyway. So if he sticks around, it'll be out of spite at this point.
Trevor, what about people that want to tap into the equity in their home? What is available to people right now to do that?
So that's a huge deal, because right now America's at an all-time high for net equity in their home.
Wow, really?
Stuff. They are. So, of course, Texas has different laws and stuff. Texas laws are you're capped out at 80% of your home's value, okay? And there's 3 different ways to access that money, okay? You can either do a straight cash out refinance, which is not a good option for the majority of people out there right now, because most people do have rates below 7.
Right.
And so doing a full cash out refinance, I would not recommend, okay? Because then you're taking your new loan into a rate 7%.
If you've got a lower loan. I mean, if you did this a year or two ago, then it may
obviously,
not be that big a
if
deal.
you had a rate at 7.5%, and some even had a rate at 8%, you know, for a certain period of time last year, okay?
Right. But they likely don't have 20%.
Yeah, those people don't have the equity position. So most of the people that do have the equity position are probably dealing with
unless they're doing the BRRRR. Unless they're doing the BRRRR method.
So, but besides that, there's 2 different options that work really, really well for people. One being a home equity line of credit. Okay. That one, you know, same rules apply, but at that point in time, they can have just kind of like a credit card. You know, say you want a $50,000 home equity line of credit. You have the equity position on your home. They give you that $50K line of credit. If you don't ever use it, you're never paying any money on it. You end up drawing $10,000, $20,000. You're paying on kind of like a credit card.
So
that one's a variable rate, though.
Let's do some simple math before you go on to your other option. Some simple math so that people understand how that works with the 80%. I know that there are no $100,000 homes anymore, but let's just pretend for the sake of conversation that there's a $100,000 value on my home.
Okay.
That means I can lend in Texas up to $80,000.
That's correct.
If I currently have a primary mortgage and my principal balance is at $50,000, that means I can go get a $30,000 line of credit.
That is correct.
There we go.
And so that home equity line of credit works. You take out $10,000 one month or something, you're paying on $10,000,
right.
And those rates, are variable and they do change. Just like
how many homes would you buy
monthly.
if you can emulate those numbers I just made up? Wouldn't that be great?
You could sign me up for. I don't know.
How many would you buy? Maybe 10 or 12 of them, like tomorrow.
I think at that point in time, I think I could afford to buy about 10 or 12, but. So that's one option. That's not the home equity line of credit is not a great option if you're going to use all of that money at one point in time that you have. Say you got $50,000 and you're going to use $50,000 right now. Okay, and the reason why I say that is because that payment is unpredictable. It's going to change every single month.
That's adjustable.
It's adjustable. The best option out there right now is.
So let me back up just to sift down a little bit on that a little bit more before you go on to your next option. What if I want to use that for acquisition? We talked about the BRRRR method. So what if we use that to help with acquisition or renovations in using the BRRRR method, right? The buy, renovate, refinance, repeat. Did I get that right?
Right.
Then if we're using it for that, how does having that line of credit affect us in that last refinance part of that BRRRR method?
That option and stuff will work, of course, on there if you're planning on paying that line of credit back, but then I'm assuming you're planning on using it again to purchase your next one, correct?
Right. Yeah. So you want to pay it off if you can when you do the refinance, right?
If I love that option for someone that is going to pay it off as soon as they renovate and refinance, use that money again, pay it off again.
Otherwise, they just have a big credit card.
Otherwise, they just have a big credit card. Yep. The other option is doing a standalone second lien cash out, refinance, which we actually that's kind of new to the market. It's been around for a long time, but we just started doing them as well. Okay. That option is the best option for most people out there. Okay.
Because it's a fixed loan.
Yeah. They're going to maintain their 3% interest rate or 4% interest rate that they currently have. And then they get to take the second lien out at current market rates of, rates right now. Are 7.25% and 7.5% on either a 10-year or a 15-year term.
I remember when we used to do those a lot. Remember back in pre-2008 when you used to do the first and seconds? Yep. The seconds, a lot of those seconds were like 12%. They were really high, 12, 13%.
These rates are really reasonable, compared to what a normal 30-year fixed rate is 7% right now. And why I like that option, it's either a 10-year fixed rate or a 15-year fixed rate. At that point in time, you have
pay it off
exactly
quicker.
What your payment is, and you can always throw more at it. So
love it.
I actually used both once. Back in 2018, they did a lot of those. So I did the home equity loans is the second lien.
Second liens once.
So
I actually used the second lien to pay off the house that it was on, and then refinance the whole house and used a line of credit to do the next house.
There you go. Leverage, using leverage in a smart way. I like it. So this option, can it be used on both primary residence and investment property?
It can.
I feel like you're asking Trevor something that you were going to ask him after this podcast now, because I'm learning something new right now.
I just found out what he can do.
Gateway's getting less conservative. No, I'm sure. All mortgage companies have to right now, right?
They're finding ways to still write loans is the main thing.
Yeah, because Yeah, the nobody wants to give up those good rates, right?
Yep.
So.
Yep. Everybody's in prison in their home right now because they don't want to give up that 3 or 4% rate.
That's really smart. That's really
let me
smart
ask
of
you
them to
some
do
rules related to that then, because this is what people get caught up, even myself sometimes. So the investment property is maxed out at 70, right?
75.
75. Okay.
Yep.
75. And then what? I guess as far as the refinance, are there any timeline rules?
There's still a 12-day, minimum 12 days that you got to wait, on the refinance. Typically, it's going to take, 21 or so anyway. So,
yeah.
But 12 is the absolute fastest they can close.
12 days. Okay, not 12 months.
Nope.
That is a significant difference. I have a question for you, Trevor. Since we've gotten out of 2020 and everything and these crazy real estate markets, what has changed with loan qualifications? Have they jumped in and added, removed, done anything to change that market?
Not really. The qualifications and stuff have remained the same throughout the whole time.
Okay.
There's some of the, what they call B and C companies, that have come into this market and then got back out again, but the standard conventional loans and FHA and VA and stuff, that they've stayed pretty consistent through this whole time on qualifications.
And then I've also heard there's a lot of counties, they're mostly around Austin, but any counties up here that are doing down payment assistance, are those programs getting a lot more common?
We've always had them around here and stuff, the different counties and stuff, and different state, programs out there that will help with down payment assistance. I use them all the time for my clients. If they qualify, it's wonderful because they're getting money and they're basically getting the same rate, if not even a better rate, with these state and county programs out there. So
I had an interesting conversation the other day about the difference between these programs and VA, which I was talking to a vet and made him realize because they were considering the two. And I was like, well, someone paying 5% of that principal for you that doesn't get charged interest does make a difference. Where VA is 0% down, but you get charged interest on 100% of that principal.
Well, and all of these programs, all of these programs will assist with VA too.
Yeah.
So they have combine the programs. We combine them all the time. So we have the programs. There's one set of rates and stuff for FHA and VA loans with down payment assistance or closing cost assistance, and they have a different rate for the conventional buyers. Okay. The conventional side is significantly higher rate than the government side, but it's awesome loan programs, for people. The main restrictions are on them, and it's county by county and stuff, but they have income limitations, that generally somewhere right around $120,000 a year or less. If you make more than that, they're not going to help you.
Yeah. Well, and that's where the teetering is right now, right? Because you almost can't afford these houses if you don't make more than that.
That's the problem.
They need to.
Obviously, if at this point in time, if you're making below that, depending on your other debts and stuff, you're probably maxing out, $300,000, $350,000 home.
And that's with a pretty clean debt to income ratio.
Pretty clean debt to income ratio from there.
Well, that's good. And that's the reason I was talking about that is because first time home buyers, it's like, well, even in this market, everything we've talked about, you should still go out and try to acquire something. Because if rates go down, you can refinance into that new rate, but you won't get the same price that you would have got.
Well, and part of that, forecast that I went and listened to the other day is what he's seeing out there is rents are actually pretty much staying stagnant, may have decreased a little bit. And the reason for that is especially in our community around here, they have way overbuilt the apartment complexes and stuff.
Yes.
At this point in time, they are done building the apartment complexes. They're not going to be building any more new ones here, on a large scale anyway. And so as soon as that building stops and those are all filled up and stuff, he expects rent prices to jump drastically. Okay. And
that's kind of what
we're talking about. He was forecasting that about a year out, sometime in 2025, that rent prices are going to start jumping back up drastically. So
I've already seen my hand. I'm really in tune to that because of the amount of homes that we manage, and every single month I have a handful of them that we have to send renewals to. So we're looking at where the current market rate is compared to where it was when we signed the last lease a year ago, right?
Sure.
And so we've talked about this on the podcast quite a bit on how we've seen, just like you said, stagnation, some neighborhoods actually going down where we're not raising rental rates on very many of our homes on a regular basis. It's starting to change. I've seen the last couple that I've done where the amount of them that I'm not changing has gone down drastically. Like there's only been a couple, right?
Sure.
And so I'm not saying that they're shooting up and skyrocketing yet, but it's a sign that that things are turning around a little bit, and rental rates are going up just a little bit in most neighborhoods, enough that we're not leaving them the same anymore like we were for a few months. So.
You get a lot of churn when that happens, you get a lot of people moving around, and hopefully they do stop building these apartments, because we've actually experienced in our business something that I've never seen before, in that the smaller family apartments, condos, they're sitting. Yeah. Like they're harder to lease than 3-bedroom houses. And that used to be, 5-10 years ago, it was like, well, you throw a 1-bedroom out there and you'll get 1 million applications for it. So it's because they started building so many 3 and 2-bedroom apartments. So, well, we appreciate the discussion, Trevor. We'll hope to have you in again. Hopefully things change in the way we've projected them, right? But if economists were better than a coin flip, they'd probably be stockbrokers, right?
Yeah, that's exactly right.
So, if you guys have any questions about anything we talked about today, give us a call, 817-818-9039, or shoot us an email at showmethemoney@wearetpm.com. Trevor, how do they get in contact with you?
You can call me or text me at 972-822-7408, or you can call or text me.
He said, when you think about emailing me, just shoot me a text. So appreciate y'all tuning in. And we are TPM, and we are out.
Later. Here, let's give it to Trevor. Boom.